This is the suspension block right here. This candlestick here is candle 1. There's a volume imbalance at the top. There's a volume imbalance at the low. And then candle number 3. And if you hit the set tab, see that? You don't get that lower volume imbalance. So that's why I toggle. I want to see where all the volume imbalances are. And if there's a setting option that when I toggle it, it gives me 2 of these on the same imbalance. I like to favor that one. All right, so we're starting to see a little bit of movement on the 1-minute chart back and forth. Still hovering around that regular trading hours opening range gap low from last Wednesday and a gradient level here on the suspension block. That's what these horizontal lines are. I dropped the fib on that from the highest high of the daily suspension block to its low, so that you can see all those levels here. The usefulness of those levels are, to me, I'm looking for and anticipating inefficiencies to form in close proximity to them. So that's why I tell you all the time that I know where my fair value gaps are going to form, and the high probability fair value gaps form in close proximity, and they're laying down some form of the fair value gap is touching it. Touching what? Touching one of the levels that is a gradient level. And that's how you know that I'm using that, or if I'm trading it, that I'm using that fair value gap, whether it be a target to support an idea around stop placement, a partial, an entry, something to that effect. But not all fair value gaps are created equal because they're not lining up with what a real fair value gap is. And it's over top, it's laying and touching a gradient level inside of a defined range. So right away, this is a morning that is either high resistance or low resistance liquidity runs. The way you determine that is the candlestick you're in right now, is it sharing the same space of the previous candle or candles? In this case, yes. This candlestick here, it's inside the previous candlestick, and it's inside of that previous candlestick. So this is high resistance liquidity run conditions. So now this is what you're supposed to do. Here we have the market trade above pre-session high. All right, so this is buy side pre-session, and this is exactly what you would be doing. So pre-session is anything prior to 9:30 opening bell, okay? So here we have a run at 9:30. The opening price is right there, okay? So that's always going to be a very sensitive price level. And then now we can look at the element of first presentation. So here's 9:30, 9:31. Now we can anticipate any fair value gap from that point on, but it has to displace. It has to be moving in a direction where we anticipate price gravitating towards. This is the part you guys are getting mixed up. So here, what is the market doing here? It takes that low out here and it closes below it, and it's doing what? It's traversing lower. It's moving lower. There's protraction moving lower. So it's displacing lower away from what has just transpired, which is that run on that buy side that was pre-session. So the market trades up, knocks out that liquidity, trades down, takes out that candlestick's low. It's leaving that liquidity pool that just absorbed all these buy stops. It collected all that. Smart money is short here. Now you have a framework as I outlined. I didn't just say it today for the first time. If you've known anything about what I teach with opening range theory, it is the first 30 minutes of trading from 9:30 to 10 o'clock in the morning. Smart money is accumulating short positions with existing orders for people that want to buy at a high price. That's what their buy stops above this high is affording them, a protection on shorts. Or they want to buy on a breakout. They think if it goes here, it's going to break out and continuously move higher. So those buyers at a higher price from where we opened at 9:30 affords smart money the counterparty to handshake with, and they will sell to them. They will give the liquidity to this existing pending buy orders. Smart money gets short here. So where does smart money offset distribute their short positions? There's two places it does it. Discount inefficiencies. That means a fair value gap below this area here. So think about it like this. Okay, so smart money went short at this level right there. In their interpretation of navigating the markets, they want to look for levels that they can buy where other traders are willing to sell to them at a cheap price. Retail traders do that. Retail traders sell something at a discount price to professionals all day long, and smart money takes those discount prices gladly. How do we do that? How do we determine that? This level here was half gap and a sell side liquidity pool. Smart money sees this as an entry, and what they're doing is they're targeting that low as I outlined this morning live stream to you. So they're looking at this as an entry, and they are looking to capitalize and consume the sell stops that are resting right below that low right there. That's their first area of offset distribution. So we have sell side liquidity here. You as a classically trained retail trader, you're looking at where's the price pattern that I can use right now, and continuation patterns, flags, pennants, head and shoulders, trend line support and resistance, all those types of things. You're trying to use that flawed logic. And I'm telling you, this is what's actually happening. Smart money sees this as an entry, and then they target the traders that are long or went long down here. What's below? If they went long here, how they protect their long position? With a sell stop. So by definition, when the market trades to that price, that sell stop becomes an order to sell at market. So it produces a flood of liquidity with the express purpose of pairing up people with the interest. They want to sell at a cheap price. This is a cheap price in relative terms to where this price was. So when I'm watching price action and when I'm reading price and when I'm teaching you to look at this dichotomy. It's how you are to interpret price action like smart money does. By having this mindset, it allows you to frame a context and say, okay, selling above the high here and targeting here, that is what? It's an implied dealing range. Anticipating a beginning of a run here and seeing it trade here for first stage offset distribution. That means partials, they can profit there, they can bank profit, and they provide liquidity at these price points too. All you have to do is know what time of the day you're trading. Look at what it's doing. Just look at where the old highs and lows are. There's a low right here. The same thing is happening. This area of entry to this, and another level would be here. So what is this level right there? That's the employment data. So anyone that was trading that, they're going to have orders resting below that. What kind of orders? Sell stops. So they could do another measure of sell stop liquidity, pairing that up with another second stage offset distribution, meaning what they sold short up here and they have left over after taking some of it off here, they can buy that back below that low right there. And it'll be like this. There's offset distribution right there. So there's two levels with liquidity. Smart money entry, first stage offset distribution. Smart money takes some of their winning position off, and then the second stage down here. So we have visually, you would interpret this as smart money going short at the high, okay, turtle soup, and then it trades lower. I told you that this would be your breaker, which is the down close candle between the high, the low, the higher high. This candlestick in here, that's your breaker, and there's your opening price as well. And then you have first presented fair value gap right there. So by having this, it trades up into that. You can color outside the lines, it's okay. And then the market sells off, and then we go into this high resistance liquidity run conditions where you got to just simply wait, just wait. And then the market starts to move lower, And then you can go into the lower time frames over here and look for inefficiencies in price action. Nice one right here. See that little gap right there? Trades to it here, sells off, uses the suspension block from the daily charts, gradient levels here, and then starts to explore lower prices. Once it gets down to this level here, it trades right back up into a gradient level once more there, and a fair value gap, and a consequent correction of this wick, which is half gap theory, same thing as the opening range gap. Trading to half gap, half range, half order block, okay, helps us define whether or not a market is bullish or bearish while a run is underway. Meaning, look at this little wick here. See that wick? If the price can't leave a body above that and it trades from here up into it, but it repels that, is that indicating that it's bullish or bearish? It's bearish. It's extremely heavy. So whenever I see a market that's bearish and it trades up into a wick like this, right there's the wick, and this is where it hits that perfectly. So it acts just like an immediate rebalance, which is extremely powerful. It's immediate response. You get immediate feedback. In the next candle, you would see it open. You want to see it become aggressively weaker. And does it do it? Yes. Trades up in a small little gap here and breaks down lower and trades down to even more of the gradient levels on that suspension block.